Good evening, everybody. It is Wednesday, May the 13th, almost halfway through the month of May already. Lots going on in the world. Never have a lack of things to discuss. So let's just take a look at what the markets did today, and then we'll try to explain why we think this happened and what's going on everywhere else. So basically looking at U.S. markets today, the Dow finished down 67 points. The S&P 500 finished up just over 0.5%, actually just a little less than 0.6%. Big winner today was technology yet again. The NASDAQ up 1.2%. Russell 2000 only up 0.04. So basically, if you look at it, the headline, S&P 500 rises to another record on the back of tech, even as majority of stocks close lower. So today is one of those days where technology has just been, all money's been running into the big tech stocks. They've continued to push up because they are such a big part of the S&P 500 that's lifting the major indice. But if you look at a more narrow indice like the Dow, which is only 30 stocks, and there are tech stocks in there, but it's still more industrials and other parts of the economy, that was actually slightly down. So a day where if you look at the headlines, all-time high on the S&P, all-time high on the NASDAQ, but it was very concentrated primarily just in technology. If we look at Europe, Europe did have a positive day. Their major indice, which is the Stock 600, their version of the S&P 500, that was up 0.79%. The DAX in Germany up over 0.75%. The FTSE in the UK up nearly 0.6. The CAC in France up a little over 0.33%. If we look at bond yields, bonds did actually get up to 4.5% today on the 10-year, but you can see right now we're at 4.467, and you can see that since the low in yields at the end of February, right before the war began, we were at 3.95%. The 10-year today is over 0.5% higher in yield. So even though stock prices are at all-time highs, bond prices are not at all-time highs. They have been impacted by the rising cost of oil. Oil today, we'll check on that in a second here. West Texas Intermediate closed today at 101, down about $1 a barrel from yesterday, but over 101. So you got oil that's run from about the mid 60s before the war, that's hovering right around that $100 threshold. That is, but that did pull back just a little bit today. But we can see a chart, a one-year chart on oil, and you can see the sharp spike at the beginning of the war, and then the volatility that we've seen in that higher range that the oil markets have been in. If we look at some commodities really quick besides oil, gold up about $11 an ounce right now, just a little under $4,700. Silver had a nice bounce today, a little over 2%, actually pushing 3%. Copper was up, platinum was up. So in that type of an environment, let's just take a look at the dollar index. It was modestly higher today at 98.47. So the dollar index is definitely down from where it was at the peak at the beginning of this war. But we did have a little bit of strength in the dollar, and you can see this is a one-year chart on the dollar, and you can see a week ago the dollar was at 97.80. So the dollar's been picking up a little bit of momentum as well, and a lot of that has to do with how well the economy is holding up in spite of the war. So if we take a look at the Atlanta Fed GDP Now forecast, this was updated last on May the 8th, so it's 5 days old. It's going to get updated, looks like tomorrow is the next update, but the last second quarter GDP forecast for the U.S. was a growth of 3.7%. So here we have all the uncertainty with the war, and yet the economy is holding up much better than most people would have expected. That's part of the strength behind the stock market, because that's certainly contributing to positive earnings in general. we know that today, and let's just go back for a second, and if we look at the economic data that came out today, we did have this week we had CPI yesterday, we had PPI today. CPI is the Consumer Price Index. That was hotter than expected. Today, the Producer Price Index, which is basically wholesale inflation measures, that came in much hotter than expected. So basically, negative, here's the consumer inflation data right here. And we basically had a bounce in the month of April of 1.4% on wholesale prices. They were expecting 0.5%, so literally came in almost triple the increase that was anticipated, and a 1 month increase of 0.5% is still a lot, but clearly 1.4, even hotter, and a lot of that attributed directly to oil, gasoline, things of that nature. The core prices were a little tamer year over year, up 2.8, but still a 0.4% increase for the month. So hotter than expected inflation data. I don't know that should be all that shocking. If you have the spike in the price of oil that we've seen lately, we know that transportation costs and everything that oil goes into, or that is derived from oil, is going up in price. And then we know that the economy is actually holding up better. So if you have a relatively strong economy and you have this spike in energy prices, all of those things lead to potential inflationary pressures. Ultimately, that was reflected in the numbers that we got over the last couple of days. So as it pertains to the direction of the Federal Reserve going forward, today Kevin Warsh was confirmed by the Senate and will be the next chairman of the Federal Reserve. So we know that is coming as soon as, I think, next week, possibly sometime. But we also know that Jerome Powell, the current chairman, soon to be former chairman, is not leaving the board of governors. He's actually simply stepping down as chairman, but staying on the board. Kind of an unprecedented move, but that is happening. We'll see what that means to the path of interest rates going forward. I think there's going to be a bit of tug of war internally, but we know in the short term, as long as this conflict is still going on in Iran and oil prices are as high as they are, I think the Fed's going to be hard pressed to be able to actually cut interest rates. But if you can get a resolution, then I think we could very well, have interest rate cuts back on the table again, especially if oil prices start to moderate. But if I look at the big news today, which I do think has had an impact on market sentiment, is President Trump is currently in Beijing, having a meeting with Chairman Xi of China, and clearly, this is a monumental meeting when you consider that, a little over a year ago is when the trade war and the tariffs and all that really heated up. Clearly, one of the primary countries impacted by the policy where we're trying to rebalance trade with the rest of the world is China. So a lot of tension with China. But I would say with the market moving as dramatically as it has recently, while the conflict with Iran is still ongoing, while the war with Russia and Ukraine between the two of those countries is still ongoing, the fact that the market has been able to kind of ignore or look past those events, I think one of the things that the market has been focusing on is optimism that the relationship between the United States and China may actually be getting ready to go to a better position than it has been, that there's some optimism that we could actually see a thawing of that almost Cold War type of mentality that was starting to develop between us and China. And one piece of evidence of that, in my opinion, is if President Trump goes to China, he probably doesn't go there without, especially in the environment that we're in, without having a high expectation of accomplishing some things that'll be notable for our country that he can basically, announce. But one reason why I think that that is entirely likely, or that they believe it's likely, is all of the CEOs that accompanied him to Beijing. As a matter of fact, the list of CEOs that traveled with President Trump on this trip is kind of crazy when you think about the firepower that went with him. The list includes, had it up here, just got to pull it up again. Here we go. Elon Musk, Tesla, SpaceX CEO. Tim Cook, Apple CEO. Larry Fink, head of BlackRock, biggest money manager on the planet. Steven Schwartzman, Blackstone CEO, private equity firm. David Solomon, chairman of the CEO of Goldman Sachs. The CEO of Citigroup, Boeing, MasterCard, Visa, General Electric, Micron, Qualcomm, Cargill, McCormick, Illumina, Coherent, other tech companies. When you're bringing the CEOs of the most powerful tech companies in the world, the most innovative technology, and then the biggest financial firms in the world, you're probably not doing that and having all of those people attend with you without having in advance negotiated things that you're likely going to be able to come out and announce at the conclusion of this meeting. I think that's the market's expectation here, is that there's some good news that's going to get rolled out. And one thing that I would say is, if you think about the conflict with Iran, clearly China, is pretty close with Iran, buys oil from them, was buying it, even though it was sanctioned, provided, was selling them military technology, which hasn't worked so well for them. But getting a deal in place with China has the potential to help put some pressure and assist in getting this conflict in the Middle East resolved. I would also suggest that the whole Russia-Ukraine situation, that if we are in a position where we might be resetting our relationship with China, or attempting to do so, that we may also be at the same time getting ready to reset our relationship with Russia, which might lead to a conclusion of that war. And clearly, that's been going on for over 4 years now, and both sides, I'm sure, are ready for this to be over, and God willing, that's what will happen, regardless of whether it's attributed to what's happening right now or whether it just happens for other reasons. But point being, I think that the markets are starting to sense that there's some pretty big things happening, that in the middle of a war, with everything going on domestically, that President Trump doesn't, stop what he's doing here and fly to China and bring all of these executives with him. If you're going over there and you're just haphazardly going to have some conversations and hope something comes about, they wouldn't be making this trip, especially bringing all of this, CEO firepower with him, if they weren't getting ready to announce that things were potentially going to get better between us and China, which I think the markets, I think global markets, I think the world economy, I think the US economy, all of them would welcome a healthier interaction between us and China. And I think that's what we could be on the cusp of seeing. And if you look at market performance, over the last, we've been trying to figure out, how is the market doing as well as it is when you're in the middle of this war, with oil prices, much higher than we want, inflation higher than we want, the Fed no longer being able to cut rates the way we were thinking. How have you gotten this kind of a move off of the bottom? Here on March 27th, S&P was at 63.56. The S&P has added 1,088 points since the lows about 6 weeks ago, and it's been pretty much a straight line up. How would the market do something like that when all of these other normally challenging, concerning things are going on, and how has the market been able to look past that? one thing could be is that there could be some awareness that has leaked out within the hierarchy of the powerful in the country. I mean, let's face it, if you're getting those kinds of CEOs to join you on your trip, you probably had to tell them what you think was going to be happening, and why it was worth their time and effort to come, and that you wanted them to be a part of it, and they wanted to be a part of it. It makes me wonder if some of that has leaked out within the marketplace and has priced in and is anticipating some good news coming out of this summit, this meeting, and that would be a reasonable explanation. We know that throughout this war, there have been weird trades that have occurred just prior to major announcements, whether it was ceasefires or things of that nature, and so clearly, somewhere within the government, at least at times, could call into question whether information that could move markets is somehow leaking out and then getting, disseminated quietly amongst players that are getting in front of this news. You've seen it with some oil trades, you've seen it with some market trades, but I wonder if the whole market has started to price something in that we are on the cusp of potentially seeing, because again, all of these CEOs didn't make this trip to China, and they're all incredibly busy as well. This was planned in advance. There had to be some sort of preconditions or pre-negotiations to this, and it doesn't mean that a deal is a done deal for certain, but it's starting to smell like maybe there is one, and the market seems to potentially be benefiting from it. Clearly, the tech stocks have really benefited from it, and I wonder if that's going to be part of this deal, is if there's some things directly that will benefit technology companies in the U.S. As a result of whatever comes out of this meeting. But just to give you a sense, the semiconductor indice, which is basically the NVIDIAs of the world and chip makers and all of that, the major benefactors of this AI push. If you look at what's been happening to the semiconductor index, it was up another 2% today. This is an index that on March 30th, looks like the low was 358. We're at 572. The semiconductor index is up 60% in 6 weeks. And those companies, many of them are so large, the NVIDIAs, that today surpass $5.5 trillion in market cap. Those have a significant impact on the NASDAQ and then also on the S&P, because they're the biggest stocks in the S&P 500. And yet the rest of the market just is kind of not really moving or going anywhere. All of the money is going into one area. Now again, is that because news has leaked and there's a reason for those stocks to be running to this extreme? What I can tell you is today a lot of the conversations that I was listening to on CNBC were basically saying that this condensed of a rally that's this narrow and in this few of stocks, that something is going to change relatively soon, that this level of concentration is unlikely to be able to be sustained for much longer than it already has been, and that one of two things likely happens. Either you see a pullback from these extremely highly bought into areas recently, or you start seeing a broadening out of the rally into other areas, which is what happened in the first, that happened late last year, first couple of months of this year. You were seeing when technology was struggling, a lot of the rest of the market starting to broaden out, and a lot of people viewed that as a very healthy thing to see happening, but we've kind of seen that reversal here in the last 6 weeks, where most everything else is kind of just meandering, not going really anywhere, and yet you're seeing, this massive move, especially in semiconductors and in tech stocks in general, a lot of the stuff that's tied to the AI trade. We'll see if there's something announced out of this summit that ultimately justifies that move and that excitement that the market has been reflecting. One thing that I would point out is, here's a stock, Home Depot, that clearly, affected by the housing market, with inflation being higher, interest rates being up, mortgage rates being up. You would assume that home builders and stocks like Home Depot would be potentially negatively affected. One thing that I would point out is Home Depot today, I think hit a 52-week low. And here's the chart on Home Depot. So when I look at a stock that, if the economy is as strong as it appears to be from the data, and as strong as the market appears to be based on earnings, it is a little bit of a potential canary in a coal mine to see a stock like Home Depot that is very likely indicative of the health of the housing market and the restoration market and basically refurnishing homes and redoing homes. To see it actually at a 52-week low, a stock that was $426 a share as recently as September, and today is at $302. So not everything is participating in this significant rally, and that is certainly one that I've taken note of. I would also point out stocks like JP Morgan, the biggest bank in the country, holding up okay, but definitely not close to its all-time highs, more economically sensitive, and at $300 a share. Let's see here, let's get this pulled up. Here we go. At $300 a share, the 52-week high on JP Morgan, it is, I don't know why it's taken so long to pull that up, but I want to say it's down about 12% or so from its all-time high. $337 a share was the all-time high, today at $300. So not all stocks are hitting all-time highs, and not all stocks are participating in this most recent rally. As a matter of fact, I would point out that since mid-April, JP Morgan, the biggest bank in the country, is down, while tech stocks are just ripping. So be aware that the rally is pretty narrow, that it's not broad-based right now, that one of two things likely comes next. Is either you see a broadening out of this rally and the rally continues, but with many more stocks and areas of the market participating, or you see the area that has run and gotten stretched correct and go through some sort of digestion period or correction period after the run-up that's occurred lately. I think by next week, when I do the next update, I think we're going to have some clarity on what exactly happens over in China and what economic impact it has and how the market potentially reacts to that. But clearly, there's a lot of optimism going into this meeting. I hope that it is justified. I hope that optimism does result in something that makes the world better security-wise, economically, and I think that the market is starting to sense that there's a possibility there. And like I said, my take on this would be, you wouldn't get all of these CEOs to hop on Air Force One and fly over to China with you unless you wanted them to be a part of something that you were about to basically announce and just kind of add to that excitement and add to the momentum of some sort of agreement that I expect they have probably all but put the finishing touches on before the trip was ever made in the first place. So I think that's kind of what the market is sensing. I don't think anyone prior to just the last few days, had any sense of who else was joining President Trump on this trip. But clearly those CEOs had to have been asked well in advance of the trip. They had to have a good reason for wanting to participate, and especially in the heightened period of risk and uncertainty that we're in with the war and everything else, I think it's very reasonable to assume that there was some sort of progress well in advance of this actual trip, and the market may very well be sensing it and starting to already price it in if it hasn't already priced it in, even though it hasn't been announced to the rest of us yet. Kind of the way the market's been working lately, but regardless, what's good for the country, if it ends up being good for the country, will be good for all of us. I really hope that that's the way it plays out. So we're going to wrap for today. As always, I want to thank you for taking the time to tune in. Please share our link with your friends, family that you think might benefit from hearing our take on what's happening in the markets, what's happening in the world. What I can tell you is that things, you know, when you consider, you can make a laundry list of all the things that are worrisome and troublesome in the world, and I can also make a really long list of reasons to be optimistic in spite of that. And I think that's the tack that the market has taken as of late, that they're looking at things more glass half full than glass half empty, and looks like maybe the spigot might be getting turned on. So time will tell. Thank you for your faith in our team. Thank you for giving us your time and attention. And until I see you next week, stay safe.